How modern finance works, the big picture. Learn the key components of modern financial systems and institutions. Imagine waking up in the morning, buying coffee with your phone, checking your salary, credit notification, investing in stocks through an app, and ordering groceries online. Most people see these actions as ordinary parts of daily life, but behind every swipe, payment, investment, and loan approval lies a massive financial system working quickly in the background. Modern finance is often viewed as complicated, full of jargon, numbers, institutions that seem distant from everyday people. However, finance is actually the invisible engine that keeps economies moving, businesses growing, governments functioning, and households achieving their dreams. Whether someone wants to buy a house, start a business, save for retirement, or simply manage monthly expenses, understanding how modern finance works is becoming an essential life skill. In today's video, we are going to explore the big picture of modern finance. We will break down 10 important components that make global financial system function, explain how they connect with one another, and show real life examples that anyone can understand. By the end of this video, we will no longer see banks, stock markets, or central banks as mysterious institutions. Instead, you will understand how money moves around the world and how these systems directly influence your financial future. Let's begin. Point number one: finance exists to move money efficiently. At its core, finance serves on primary purpose, moving money from places where it is abundant to places where it is needed. Throughout history, people accumulated savings, others needed money to expand the businesses, build homes, or fund new ideas. Modern finance developed as a system that connects these savers with borrowers. Imagine a young entrepreneur wanting to open a bakery. She needs $1,000 to purchase equipment, rent a store, and hire staff. Instead of borrowing from family members, she can obtain financing from banks, investors, or financial markets. Meanwhile, thousands of individuals deposit their savings into banks because they want safety and earn interest. Banks collect these deposits and lend them to entrepreneurs. This process creates economic growth. Without finance, savings would remain idle, businesses would struggle to expand, and innovation would slow significantly. Finance acts like the circulatory system of an economy. Money flows through households, businesses, governments, and investors, much like blood flows through the human body. When the circulation works efficiently, economics prosper. When it becomes blocked, economic problems emerge. Let's say example, if millions of people save money in banks, banks can provide mortgages that help families purchase homes, stimulating the construction industry and creating jobs transition. But who ensures that these banks themselves operate safely? Let's move to the second building block. Next point number two, banks are the foundation of the financial system. Banks are among the oldest and most influential financial institutions. Their primary functions include accepting deposits, providing loans, facilitating payments, and safeguarding people's money. Commercial banks serve individuals and businesses. Investment banks help companies raise capital. Digital banks are now transforming banking services through technology. Banks create confidence within the economy. People trust banks to keep their savings secure. Businesses depend on banks for working capital. Governments use banks to distribute social benefits and tax refunds. Banks also contribute to money creation. When banks issue loans, they effectively increase the money circulating within the economy. This makes banks highly powerful institutions. However, excessive lending can also become dangerous. Poor lending decisions contributed significantly to the global finance crisis in 2008. As a result, modern banking regulations have become stricter. Banks are now required to maintain reserves and comply with risk management standards. Let's say example. Suppose Rahul deposits $1,000 into a bank. The bank may lend $800 to a small business owner. That business purchases equipment. The equipment supplier deposits the payment into another bank. The money continues circulating, the supporting economic activity. Transition. If banks are the foundation, the central banks are the architects overseeing the entire structure. Next point number three. Central banks control the economic environment. Central banks occupy a unique position within modern finance. They are often called the banker's bank. Their main objectives include maintaining price stability, controlling inflation, supporting employment, and preserving financial stability. Central banks influence interest rates. Higher interest rates discourage borrowing. Lower interest rates encourage spending and investment. Central banks also supervise commercial banks and manage national currency supplies. During economic downturns, central banks inject liquidity into markets. During periods of excessive inflation, they tighten monetary conditions. Their decisions impact mortgage rates, credit card interest, business loans, and investment returns. People often overlook how central banks influence daily life, but even car loan rates depend heavily on their policies. And let's say example during the COVID-19 pandemic, many central banks lowered interest rates dramatically. This encouraged businesses to borrow, households to spend, and economics to recover faster. Transition. Money alone is not enough for companies to grow. Businesses also need access to investors. That's where capital markets become essential. Next, point number 4. Capital markets help businesses raise funds. Capital markets connect businesses seeking capital with investors seeking returns. These markets include stock exchanges and bond markets. Companies issue shares to raise ownership capital. They issue bonds to borrow money. Investors purchase these securities hoping for future gains. Capital markets allow businesses to expand without depending entirely on banks. Public companies can attract billions of dollars from investors worldwide. Efficient capital markets encourage innovations. They support technological advancements. They finance infrastructure projects. They contribute significantly to economic growth. However, market prices constantly change due to investor expectations, economic conditions, and geopolitical events. Understanding these fluctuations is important for long-term investors. Let's say example, a technology company planning international expansion might sell shares through an initial public offering. Investors purchase these shares because they believe the company will become more valuable in the future. But investors don't always invest directly. Many rely on professional intermediaries. Next, point number 5. Financial institutions manage and allocate investments. Modern finance includes numerous specialized institutions: asset management companies, mutual funds, insurance firms, pension funds, private equity firms, hedge funds. Each serves different purposes. Mutual funds pool money from thousands of investors. Insurance companies protect people from unexpected losses. Pension funds manage retirement savings. These institutions improve efficiency because professionals analyze investments on behalf of clients. Diversification reduces risk. Investors gain access to opportunities they might not reach individually. Financial institutions therefore play a critical role in wealth creation. Let's say example, instead of buying individual stocks, a teacher contributes monthly to a mutual fund. Professional fund managers allocate investments across multiple industries. This reduces concentration risk. Transition. Investment opportunities are expanding rapidly because technology is changing finance. Next, point number 6. Financial technology is reshaping the industry. Technology has revolutionized modern finance. People can open bank accounts online, transfer money instantly, invest globally, receive loans within minutes. AI improves fraud detection, blockchain enhances transparency, digital wealth simplify payments. Financial inclusion is increasing. Millions who previously lacked banking access can now participate in the formal economy. Technology reduces operational cost, it increases convenience. However, cybercrime risks are also growing. Data privacy remains an important challenge. Financial literacy is becoming more valuable than ever. Let's say example, a farmer in a remote village can receive payments through a smartphone app without visiting a physical bank branch. Transition. While technology offers opportunities, managing financial risk remains essential. Next, point number 7. Risk management protects the financial system. Risk is unavoidable in finance. Borrowers may default, markets may decline, currencies fluctuate, natural disasters can occur. Financial institutions use sophisticated techniques to manage uncertainty. Diversification spreads investments. Insurance transfers risk. Derivatives help hedge against market movements. Stress testing evaluates resilience under adverse scenarios. Strong risk management prevents crises from escalating. Weak risk controls can trigger systematic failures. Such as example, an airline company purchases fuel futures contracts to protect itself against rising oil prices. This stabilizes future operating expenses. Transition for that. Even well-managed systems require trust. Trust depends heavily on regulation. Next, point number 8. Regulation maintains stability and confidence. Financial regulations establish rules that institutions must follow. Regulators monitor banks, protect consumers, prevent fraud, combat money laundering, promote transparency. Financial crises often lead to stronger regulations. Regulatory frameworks evolve continuously. Effective oversight encourages investor confidence. People are more willing to save and invest when they trust the system. Excessive regulation may reduce innovation. Insufficient regulation increases stability. Finding balance remains challenging. Let's say example, capital requirements ensure banks maintain sufficient reserves to absorb losses during economic downturns. For the transition, modern finance has become increasingly interconnected across borders. Next, point number 9. Global financial systems are highly connected. Money moves internationally within seconds. Investors diversify globally. Companies operate across continents. Economic events in one country can influence markets worldwide. Trade relationships connect national economics. Exchange rates affect imports and exports. International institutions support cooperation among nations. Globalization creates opportunities, but it also transmits shocks rapidly. Understanding global linkages is important for modern investors. Such as example, interest rate increase in one major economy may cause investors worldwide to shift capital toward safer assets. Emerging markets often experience immediate effects. Transition for that. Ultimately, modern finance should serve society. Its success depends on how effectively it improves people's lives. Next, point number 10. Financial literacy empowers individuals. The most important component of modern finance is the individual participant. Financial literacy enables better decisions. People learn budgeting, saving, investing, borrowing responsibly, planning retirement, evaluating risk. Knowledge reduces vulnerability to scams. It increases confidence. Financial education supports long term wealth building. Modern finance offers tremendous opportunities, but those opportunities benefit people most when they understand how the system functions. Finance should not be viewed as an elite subject reserved for professionals. It is a practical tool that everyone can use. Such as example, two individuals earn identical salaries. One spends everything immediately, the others invest consistently. Over several decades, disciplined investing can create sustainable wealth. Finally, modern finance is much more than banks, stock markets, or complex economic theories. It is a vast economic ecosystem designed to channel money, manage risk, support innovation, and create opportunities for individuals, businesses, and nations. Today, we explored how money moves through banks, central banks, financial markets, investment institutions, technology platforms, regulatory systems, and global networks. Understanding this big picture helps us become smarter savers, more confident investors, and better decision makers. Finance affects nearly every aspect of our lives, from the homes we buy to the careers we pursue and the futures we build. The more we understand it, the more effectively we can participate in shaping our own financial destinies. If you enjoyed this video, don't forget to like, subscribe, and share it with someone who wants to understand how the modern financial world really works. Until next time, keep learning, keep investing in knowledge, and remember, money is powerful, but understanding money is even more powerful.